I want to start with a number that usually signals the end of a company, not a new beginning. -3%.
Right.
That is the year-over-year revenue growth for Tesla in 2025. For a company that has, traded for a decade on the promise of hypergrowth, shrinking usually implies dying.
Mm-hmm.
And yet, if you look at the stock chart following the earnings call on January 29, 2026, it looks like a vertical launch. What on earth are we missing here?
We're missing the distinction between a car company and, well, what other Tesla is becoming.
Okay.
If you look at the documents from this quarter, you're actually reading two different stories at the same time.
Two stories.
Yeah, story A is an automotive manufacturer that's hitting a saturation wall. Sales are down. The Europeans are buying Volkswagens. The Chinese are buying BYDs. I mean, if that were the only story, the stock would be crushed. It would be a complete disaster.
But it wasn't crushed. Not at all. The market reacted as if they just announced they'd found, I don't know, gold under the factory floor.
Because of story B. And story B is that the car company is effectively being liquidated slowly to fund this massive venture capital bet on robotics and what they're calling physical AI.
So the market isn't pricing in car sales anymore?
Not really. They're pricing in the burn the ships moment. They're pricing in a complete industrial metamorphosis.
Burn the ships! I saw that phrase pop up in the analyst notes we reviewed. It's such a dramatic historical reference, right? Cortez landing in the New World, destroying his fleet so his soldiers had no option but to conquer or die.
Yes, pretty intense.
It makes for a great movie trailer, but is it accurate for a publicly traded company? I mean, usually when a CEO pivots, they hedge their bets, they keep the cash cow alive and comfortable while they experiment over in the lab. You're suggesting Musk is doing the opposite.
He is dismantling the cash cow. That is the nuance I think people missed in the headlines.
How so?
It's not just that they're launching a robot. It's that they are physically ripping out the infrastructure of their most iconic vehicles to make room for it. It's a binary bet. There is no going back from this.
Okay, that is a terrifying prospect for a shareholder who just wants a safe return. But before we get to the robots and the sci-fi future, I need to understand the money. You can't build a massive future with empty pockets.
Sure.
You mentioned revenue was down -3%, but I'm seeing here that they beat profit expectations. How do you sell fewer things, bring in less money, and still tell Wall Street, hey, we actually made more profit per share than you thought? That sounds like accounting magic.
It's not magic, it's ruthlessness. It's a combination of extreme cost cutting and something called business mix.
Okay, break that down for me.
Let's get into the financials from Q4 2025 because they are the foundation for everything else we're going to talk about.
Okay.
Yes, automotive revenue took a beating. It was $17.7 billion, down 11% year over year. They sold fewer cars, period.
Which usually destroys your margins. I mean, if you have a giant factory and you run it at lower volume, you're paying for lights and workers to just stand around. Your profit per car should plummet.
Exactly. That's the rule of thumb in manufacturing. But Tesla's gross margins actually went up.
Bob.
They hit 20.1% compared to 16.3% the year before.
How is that even possible?
Two big reasons. First, they stopped selling low-margin cars in low-margin regions. They focused on where they actually make money. They cut out the fat. But the real savior, the thing that effectively subsidized the entire auto slump, was the energy division.
The batteries. The megapacks.
Yeah, and we have to stop thinking of the energy division as some kind of side project.
It's a real business now.
It grew 25% year over year. It brought in $12.8 billion in fiscal year 25. The profits there are record-breaking. So while everyone was watching the Cybertruck delivery numbers, the energy division quietly became this utility-scale juggernaut.
So it's providing the cash flow buffer.
It's the buffer that allows them to absorb a hit on the auto side.
Yes. So the battery business is effectively the insurance policy for the car business shrinking.
In a way, yeah. It's becoming the boring, stable utility company that generates the cash flow, which in turn allows Musk to treat the car business as this volatile experiment. And look at the cash on hand. This is the most critical number in the entire report, $44.1 billion.
$44 billion. That's the fortress balance sheet the bulls are always talking about.
Precisely. If a normal car company shrinks 3%, they panic about paying their debts. They start layoffs to save cash.
Right.
Tesla shrinks 3% and sits on $44 billion. That liquidity allows them to basically ignore Wall Street's quarterly demands for a year or two.
So they don't have to panic.
They aren't acting like a struggling automaker running out of runway. They're acting like a bank with a manufacturing addiction. They're liquidating their legacy business to fund a science project.
Okay, let's talk about that liquidation, because this is where the burn the ships strategy moves from just a metaphor to a physical nuts and bolts reality. Section 2 of our dive deals with a specific announcement that, honestly, it felt like a funeral to me.
The Model S and Model X.
They're dead.
Honorable discharge. That was the specific phrasing Musk used.
Which is corporate speak for, we are killing it. But I have to push back on the logic here. The Model S is the car that made EVs cool. It's the halo product. It's the reason we aren't all driving glorified golf carts, you know?
Oh, I know.
Even if sales are low, don't you need a flagship? Mercedes doesn't sell a million S-classes, but they build them to show that they can. Why kill the brand image?
Because of physics. This is where this deep dive gets really interesting. It's not about brand, it's about square footage. Meaning the Fremont factory in California is one of the densest, most crowded manufacturing footprints on the entire planet. It is bursting at the seams.
Right.
If you want to build something new, say the Optimus robot factory, you physically cannot do it unless something else leaves the building. You can't just build a new wing. There's no land left to build on.
So they're cannibalizing the grandfather to feed the grandchild.
That's a brutal way to put it, but yes. The sources confirm they aren't just stopping the lines, they're tearing them out. They are unbolting the robots that built the Model S to install the lines for Optimus.
Wow.
This is a one-way door. You can't just turn it back on if the robot thing doesn't sell.
That feels incredibly risky. You're trading a product that you know works, even if it sells in low volumes, it's a known quantity, for a product that, let's be honest, we haven't seen do much more than fold a t-shirt in a highly edited demo video.
In the definition of high risk. But look at the CapEx guidance, the capital expenditure. They are guiding for over $20 billion in spending this year. For context, in 2025, CapEx was under $9 billion.
So they're more than doubling their spending while their revenue is shrinking.
Yes.
That is a staggering amount of money.
Yeah.
Where does $20 billion even go if you aren't building new car lines?
It goes into building a completely new industrial base. The outline lists 6 specific new production lines. They aren't just buying parts off a shelf, they are building the entire infrastructure. Like a lithium refinery, LFP, battery factories, the Cybercab line, the semi-line, a new mega factory, and of course the Optimus factory. And that's before you even get to the Cortex superclusters for AI training.
So this isn't R&D money. This isn't just paying scientists to sit around and think. This is buying concrete and steel.
Correct. They are building the machine that builds the machine. And they are betting that the floor space at Fremont is worth, I don't know, 100 times more producing robots than it is producing luxury sedans.
Let's talk about that robot, Section 3, Optimus. Because the numbers they're throwing around here they're difficult to comprehend. The target is 1 million units a year.
From that repurposed Fremont space, yes.
1 million robots. A really successful car plant makes, what, 500,000 cars a year?
On a good year, yeah.
They want to double that volume in the same building for a product that doesn't strictly exist yet.
It sounds impossible. And if you looked at the S-curve discussion in the transcript, Musk is practically admitting that the first year is going to be hell. He specifically warned investors about the S-curve.
We hear about the S-curve a lot in tech, but usually it's in terms of adoption, like how fast people bought smartphones. How does that apply to manufacturing?
In manufacturing, the S-curve is the painful period where you are spending billions and producing almost nothing. It looks flat. It looks like a failure.
You're just burning cash.
You're burning cash and you're solving thousands of tiny problems every single day. But once you solve them, production goes vertical. And Musk used a phrase that I think is crucial to understanding why this is so hard. Physics first principles regarding the supply chain.
Translate that for the non-engineer. What does physics first principles mean when you're trying to order parts?
It means the catalog doesn't exist. Okay, look, if I want to build a new electric car today, I can open a catalog from Bosch or Continental or Brembo. I can order steering racks. I can order brake calipers. I can order wiper motors. The industry has spent 100 years standardizing these parts.
Right. You aren't reinventing the wheel. You're just buying it and bolting it on.
Exactly. But if I want to build a humanoid robot, where do I buy the hand?
Yeah. Well, I assume someone makes robotic hands.
Yeah, like this.
Yeah.
You have industrial grippers, sure, claws, big dumb clamps.
Right.
But there is no supplier for humanoid wrist actuator with 11 degrees of freedom and tactile feedback sensors that costs $50. It doesn't exist.
So Tesla has to invent it.
Tesla has to design the copper winding, the magnets, the gear ratios, the sensors. They have to build the machine that makes the part before they can build the part that goes into the robot.
That explains the slow ramp. They're literally inventing the supply chain in real time.
And the hand is the bottleneck. Musk called it the hardest problem.
Why? I mean, we've had robotic arms in factories for 40 years. They pick up heavy cars all day long. Why is a human hand so hard to replicate?
Because a factory arm is dumb and strong. It does one thing: move here, clamp, move there, unclamp.
Right.
And it crushes whatever is in its way if it's not perfectly calibrated. A human hand is a paradox. It needs enough force to crush a rock, but it also needs enough sensitivity to hold a raw egg without cracking it.
And do both.
And do both. It needs to thread a needle and swing a hammer.
And it has to fit in a package the size of, well, a hand. You can't have a giant hydraulic pump attached to it.
Exactly. Hydraulics are too messy, they leak. Pneumatics are too spongy. Standard electric motors are usually too big or too weak. Packing 20-plus actuators into a space the size of a grapefruit while keeping it durable enough to withstand falling over, that's a genuine engineering nightmare.
So when they talk about physical AI, they aren't just talking about the brain, the software. They're talking about the hardware being capable enough to actually execute the brain's commands.
Right. It's the mannequin argument. You could have the smartest AI in the world. Grok could be a genius. It could know how to perform open heart surgery. But if the robot is just a stiff mannequin that can't manipulate the scalpel, the intelligence is useless.
The value is in the interaction with the physical world.
Exactly.
And that interaction comes at a cost. There was a comparison in the notes about the cost per pound that I found just fascinating.
This is the economic hurdle. Right now, a Tesla Model 3 costs about $11 per pound to manufacture. It's mostly steel, glass, and battery. Efficient, heavy, cheap.
$11 a pound. Okay.
Optimus, based on current estimates, is costing them around $240 per pound.
$240
per pound.
That is a massive gap. That's aerospace pricing, not automotive pricing.
It is. It's because of all those custom actuators and sensors and the sheer complexity. For this business model to work, for this to be amazing abundance and not just a toy for billionaires, they have to drive that cost down from $240 to something closer to $20 or $30 a pound. They have to make them miraculous cheap.
But if they do, the argument is that it fundamentally changes the GDP.
The GDP multiplier. This is a huge macroeconomic thesis. Labor is the primary constraint on all economic growth. There aren't enough people to build houses, care for the elderly, or work in mines. If you can inject 1 million new laborers per year into the economy, laborers that don't sleep, don't get injured, and work for the cost of electricity, you theoretically uncap GDP. You move from a cyclical auto market to a labor substitution market.
It sounds utopian or dystopian, depending on how worried you are about your job.
It's the ultimate bull case. But we have to remember, right now, it is still a research project. They haven't sold a single one.
Right. We are betting on potential. But let's talk about the other bet, the one that involves actual cars, but in a very different way. Section 4, autonomy, and the Cybercab.
This is the bridge. This is the bridge between the old Tesla and the new Tesla. The Cybercab is slated for production in April 2026.
And this isn't just a Model 3 with the steering wheel ripped out. It's a ground-up design.
Completely different. 2 seats, no steering wheel, no pedals.
2 seats? That seems limiting. Why would you build a taxi that can't carry a family of 4 to the airport?
Data. Pure data. Tesla analyzed billions of miles of driving data from their fleet. They found that 90% of vehicle miles traveled in the U.S. involved just 1 or 2 people.
So dragging around 5 empty seats in a huge skunk is just wasted energy.
It is thermodynamic inefficiency. If you're building a robotaxi network to be cheaper than a bus ticket, you cannot waste energy moving empty air around. It's designed for a specific duty cycle. A personal car, your car sits parked 95% of the time. The Cybercab is designed to run 50 to 60 hours a week. It is built more like a commercial truck or a subway car in terms of durability than a passenger sedan.
But here's the part that really caught my attention, especially for the existing owners, the Airbnb model. This feels like a fundamental shift in what it means to own a car.
This is where the financialization of the vehicle comes in. Musk is pitching a future where your car is an asset, not a liability that just sits there depreciating.
So explain the mechanics. I own a Tesla, I drive it to work, then what happens?
You park at 9 a.m. Usually your car sits there losing money. Under this model, you tap a button on your app that says Join Fleet.
Okay.
Your car drives off. It picks up passengers. It earns fares. It handles all the logistics. Then at 4:45 p.m., it drives back to your office to take you home.
Getting paid to own a Tesla?
That's the entire pitch. The claim is that you could earn more lending your car out than your monthly lease payment. You essentially get a car for free, or you could even turn a profit on it.
That sounds incredible, but it relies on one massive, glaring assumption.
The big one.
That the car can actually drive itself without crashing, without getting stuck, and without a human babysitter.
The unsupervised FSD assumption. This is the linchpin for the whole thing.
And where are we on that? Because, I mean, we've been hearing FSD is almost here for a decade. Is it actually different this time?
The update from this quarter was significant. They aren't just testing anymore. They are running paid rides in Austin, Texas right now with no safety monitor and no chase car.
Wait, clarify that for me. No one in the driver's seat. And no guy in a Ford Explorer following behind with a kill switch.
Just the car and the passenger.
Yeah.
That is a major validation step.
Yeah.
It means their internal safety data is robust enough that their lawyers and their insurance underwriters signed off on the liability.
But that's Austin. I mean, Austin is relatively flat, it's sunny, and they've probably mapped every single inch of it. What about Boston in a snowstorm? What about New York City traffic?
That is the regulatory risk. That's the big wall.
Mm.
They're aiming for 1/4 to 1/2 of the U.S. by the end of year 2026, but without federal preemption.
Meaning a national law.
Right, a national law that says if the robot is safer than a human, it's legal. They have to fight city by city, state by state.
It's the Uber fight all over again, but with a much higher stakes because there's no driver to yell at if things go wrong.
And there's a business model shift here, too, that's important. Subscription FSD.
Mm-hmm.
They're moving away from selling the software for a one-time fee of, $12,000.
They want recurring revenue.
They want to be the software as a service model of transport.
Okay, let's zoom out for a second. We have robots. We have robotaxis. We have this massive data processing requirement for all of it.
Section 5, the infrastructure, the plumbing of physical AI.
This is the part that often gets overlooked, but it is exactly why that CapEx number is $20 billion. You can't just build the robot. You have to build the brain and the power source for the brain.
Let's start with the terafab. That sounds like something out of a Marvel movie.
It does. It's a proposed domestic semiconductor plant, a vertically integrated chip factory.
Why? I mean, Tesla's a car company. Why do they need to build their own chip factory? Can't they just buy from NVIDIA or TSMC like everyone else?
They could, and they do. But there are two huge problems with that. One is supply. Everyone on Earth wants NVIDIA chips right now. If you want to build 1 million robots, and each robot needs a powerful inference chip, you simply can't be waiting in line behind Meta and Google and OpenAI.
So it's about not being bottlenecked by a supplier.
Exactly. But the second reason is geopolitical. Where are the most advanced chips in the world made?
Taiwan. If anything happens in that region, a blockade, a conflict, an earthquake, Tesla's entire supply chain for its future freezes instantly.
So the terafab is insurance. It's about sovereignty.
It is about controlling their own destiny. If they build it, they own the silicon.
And then there's the connection to xAI. We saw a $2 billion investment mention. This is Musk's separate AI company. How does that fit into the Tesla picture?
Think of xAI and its model Grok as the orchestra conductor.
Okay, expand on that metaphor for me.
The Tesla car, or the Optimus robot, has a local brain. It knows how to not fall over. It knows how to avoid a pedestrian. But it doesn't necessarily have the high-level reasoning to manage a fleet or understand complex long-term commands.
I see.
xAI provides that high-level reasoning. It's the central intelligence that tells the fleet what to do. The individual robots just figure out how to do it.
That is a terrifyingly efficient concept. A whole fleet of robots managed by a super-intelligent AI. But there's a limit to all of this, isn't there? Energy.
Energy is the hard cap. AI compute needs massive, massive amounts of power. The more intelligent the model, more electricity it burns. And our grid on Earth is, well, it's old, it's dirty, it's constrained.
Which brings us to the wildest detail in all the notes. I had to read this twice to believe it. Orbital data centers.
Solar in space?
Solar in space? That sounds like Bond villain territory. What is the actual logic there?
It's surprisingly sound from a physics perspective. On Earth, solar power is intermittent. You have night, you have clouds, you have winter. So you need huge, expensive batteries to store the power for when the sun isn't shining.
Right.
In orbit, if you position the satellite correctly, you have 247 sunlight. No clouds, no atmosphere to filter the light. It's just pure, constant energy.
So you have infinite, continuous, clean energy.
Right. So the proposal is the servers, put the servers in space, launch the AI chips via SpaceX, power them with massive solar arrays, do the heavy thinking in orbit, and just beam the answers down via Starlink.
It completely bypasses the terrestrial grid. You don't need a permit from the city to plug it in.
It is the ultimate vertical integration. Tesla makes the battery, SpaceX launches the satellite, xAI provides the brain, Starlink carries the data, and the robot on the ground does the work. It's a closed loop that no other company on Earth can even dream of replicating.
It is an incredibly grand vision. I'll give them that. But, and there's always a but, we have to look at the price tag. Section 6. The verdict. Because we started this episode talking about a car company with shrinking revenue.
The valuation disconnect, this is the big one.
The stock is hovering around $420 a share. The PE ratio, price to earnings, is somewhere between 90 and 190, depending on which metric you use.
It's nosebleed high. For reference, a typical car company like GM or Ford trades at a PE of maybe 5 or 6.
5 or 6. Tesla is trading at nearly 200.
Yeah.
So the market is clearly not looking at the car sales at all.
No, absolutely not. If you are buying Tesla stock today, you are not buying a car manufacturer. You are buying a call option on the future. You're buying a ticket to the Musk Venture Capital Fund. You are betting that Optimus and Cybercab will work and that they will monopolize the market when they do.
And if they don't?
That's the risk, and the risks are massive. We talked about execution, risk building a supply chain that doesn't exist. Delays are almost guaranteed. We call it Musk time for a reason, right? 2026 might become 2028.
And the financial cliff.
They are burning $20 billion a year in CapEx now. They have $44 billion in cash. You do the math. That's a 2-year runway if they don't keep generating cash from the core business. If revenue keeps dropping, that cash pile shrinks very, very fast.
And we can't ignore the regulatory wall. If the government just says, no, robots can't walk on sidewalks, or no, cars can't drive without wheels, the whole thesis collapses overnight.
It does. But the bull case is just as extreme on the other side. If they solve autonomy and robotics, the auto business becomes a rounding error. It becomes irrelevant. They essentially monopolize physical labor and movement.
It's a winner-take-all scenario. There's no middle ground.
Risk defined, portfolio protected. That's the mantra. But it is a binary outcome. It's either a 0 or a trillion.
So let's wrap this up. We've unpacked the death of the Model S, the rise of Optimus, the $20 billion bet, the shift from selling cars to selling labor.
From Model S to amazing abundance.
It really is a new book, not just a new chapter. 2026 is the year Tesla stopped being a car company and started being whatever this is.
The physical AI infrastructure company.
Physical AI company. It's fascinating. And frankly, it's a little scary.
Innovation usually is.
I want to leave you, the listener, with a thought, something that really stuck with me from that Airbnb discussion. We are moving toward a world where your car isn't just a machine you own, it's an asset that works for you. Imagine a future where your car drops you off, goes out and works an 8-hour shift, taxing people around, earns its own lease payment, and maybe even earns you a salary, all while being powered by a solar farm floating in orbit.
It completely changes the definition of ownership. Is that ultimate freedom? Or is it the ultimate financialization of our lives where every single thing we own has to be productive?
That is the question. And for Tesla, the answer lies somewhere in that Fremont factory, where right now, as we speak, they are tearing out the past to build the future. Thanks for diving deep with us. We will see you next time.